Hello, welcome to the Digital Enterprise Society webinar series. My name is Courtney McWhirter. I'll be your host for today's webinar, Helping Manage Your Wealth While Achieving Your Financial Goals. This is kind of a little bit different than things that we normally do, and we appreciate Charles Boulware is our Digital Enterprise Society financial advisor and offered to provide today's webinar as kind of a little bit of a bonus to our members during some of these difficult times. So we thank him for that. Digital Enterprise Society is a new nonprofit member association organized to enable the transformation of product development, design, delivery, and maintenance throughout the digital enterprise, regardless of software tools used. We are dedicated to the transformation of the manufacturing enterprise workforce. If you haven't already, we welcome you all to join Digital Enterprise Society. You can visit us at digitalenterprisesociety.org. My name, again, is Courtney McWhirter. I'm the Marketing Communications Manager at Digital Enterprise Society. If you have any questions about membership or getting involved, please feel free to contact me. And I'd like to welcome again Charles Boulware, our speaker for today. Charles joined Morgan Stanley in 2014 to access the company's world-class resources and exceptional service. For over 20 years, he has been providing guidance on retirement income planning for retirees and pre-retirees and wealth building strategies for goal-oriented families and individuals. Charles is focused on providing clients with proactive wealth management strategies, a high level of communication, and exceptional service. With decades of experience, he can help you navigate the complex financial markets in an effort to attain your financial goals. Before we get started, I know today is a little bit different than our typical, is that we do have the option to do voice questions, but I do ask that any questions you have throughout Charles's presentation that you go ahead and put in the chat for us, and we'll do brief Q&A following his presentation. If we are able and anyone is interested in actually coming on live and asking their questions via audio, I can unmute you on a case-by-case basis. So for right now, if you would please stick to the chat for any of your questions, we'd appreciate it. And now I am going to turn the presentation over to Charles and let him get started.
So again, thank you for joining us this afternoon. Objective of today's webinar is to briefly review the current economic and market environment, and then get you familiar with the capabilities of Morgan Stanley Wealth Management and how we help manage your wealth while achieving your financial goals during these uncertain times. So let's get started. This is one of my favorite quotes from Yogi Berra. You've got to be very careful if you don't know where you're going, because you might not get there. And I think it applies to the importance of financial planning in our business. When it comes to having a basis for investment decision making, a plan is about as close as we're going to get to the quote unquote crystal ball. And it helps answer that main question of how aggressive or conservative you should be with your savings. I would say probably 90% of the people that I sit down with for the first time don't have a plan in place that assesses the key areas such as retirement, estate, and tax planning. For the other, call it 10%, that do have it in place, maybe half of those folks have actually followed it. For the other half, unfortunately, their plan, I think, tends to get ignored because of lack of communication, process, discipline, or all the above. So if there's a main takeaway for today, it's to have a plan along with a disciplined process that reassesses and keeps you on track with your objectives. I think this, especially during this uncertain time, helps take emotion out of the equation. So let's take a look at what's happening in both the economy and the market, and then we'll revisit the planning process and the capabilities of Morgan Stanley. It's official. We're in a recession. I think that was declared at the end of last week, or it was yesterday. I lost track of time. And as with every recession, the path to recovery is unknown. No one knows for sure the duration, the damage done, but that eventually there will be a recovery. The difference with this one, as compared with the normal cyclical recession, is that it was the result of a mandated time out, so to speak, of individuals and businesses by the government. So to help address the challenge of trying to monitor the near overnight collapse and what seems to be the day-to-day evolution of the economy in real time, the Federal Reserve Bank of New York devised this weekly economic index depicted here to measure real economic activity at a weekly frequency. And while the restrictions to stem the spread of the coronavirus have eased as the economy is now reopening, Fed officials still acknowledge that the path to recovery remains highly uncertain. There's still significant downside risk, and they've indicated potential need for more stimulus. I don't know if anyone had a chance to see the 60 Minutes interview with our Fed Reserve Chairman Jerome Powell, where he declared that despite the economic recovery possibly stretching to the end of next year, quote, in the long run and even in the medium run, you wouldn't want to bet against the American economy. However, as depicted by this graph, the economic toll remains visible. Trajectories are improving. Notably, the May job report from this past Friday, which was the polar opposite of what most analysts were forecasting. And the economy actually added jobs and the unemployment rate came down. It's still grim, but some improvement. So with that policy support and the Fed support, Morgan Stanley's Global Investment Committee thinks that stocks won't revisit their March 23rd low, but to expect range-bound conditions that may persist for the next 3 to 6 months. The S&P 500 tracks the performance of 500 widely held large capitalization U.S. stocks. This table shows valuation measures, essentially slicing the index in every which way we can, with underlying earnings, cash flow, book value, enterprise value, and so on. The red borders in the percentage above column, the red borders indicate metrics are trading above their historic average, while the green are trading below. The market is up over, I think, 35% since the March 23rd low. Some believe that these fundamental factors matter, while others don't. The ones that don't, I think, argue that the market is always forward-looking and that company earnings, cash flow, all those ingredients will catch up to improve the fundamental factors, but which you can see here, most of them are all trading above their historical average. So what's a prudent investor to do? I mentioned in the beginning that having a plan is a basis for investment decision making. We can look at risk in two ways. There's the ability to take on risk, and there's the willingness to take on risk. The financial plan, I think, assesses the ability, which is the vertical axis here. It's also known as investment longevity. It tracks whether you're on, above, or below target with all of your financial goals. For example, above average ability means that you have zero to little need for investment distribution, while below average could mean that you're banking on your majority of your savings for month-to-month committed expenses. The risk willingness, which is the horizontal axis here, is simply your tolerance for disappointment, whether you're risk averse, more conservative by nature, or risk seeking and more aggressive by nature. So whether you're worried that it's been too quick of a recovery with little tolerance, I should say market recovery, not economic recovery yet, but market recovery with little tolerance for disappointment, which would be the left quadrants here, or you believe that the economic improvement is underway with all of this Fed stimulus and government backing, and things can only get better from here. But in the event you're wrong, you have an above average tolerance for prolonged market swoons. That's the right quadrants. There's always a place for rebalancing. Markets are dynamic, especially over the last few months. It's been highly volatile, and that tends to alter allocations. So rebalancing helps make sure your current portfolio continues to reflect your objectives, income needs, and time horizon. It's complicated. Everyone's different. Life's complicated. You have unique financial concerns and needs. Your life stage changes, so do your goals. Early on in your career, your goals may be to buy a home, start a family, build an emergency fund. Later, your priorities could shift to sending your children to college, assisting aging parents, planning for retirement. And then in retirement, your focus may be on maintaining your lifestyle, meeting healthcare expenses, and creating a legacy for children or grandchildren or charities of choice. Morgan Stanley's platform allows you to look across your assets and liabilities and help you adapt your wealth management strategy to meet those changing demands. We can provide you with guidance that goes beyond just investments to encompass virtually every aspect of your financial life. To implement your goal-based wealth management strategy, we draw from Morgan Stanley's selection of products and services, from wealth planning and strategic portfolio advice to insurance and annuity recommendations that can help protect assets from unexpected downturns. My goal is to manage all of that, manage your financial life, no matter how complex your specific situation is. Our goal-based process is known as the Goals Planning System, GPS. It's an ongoing process that helps ensure your wealth management strategies are always aligned with your goals, even if your goals change over time. We have an integrated platform that ties your goals to implementation. So this diagram illustrates the key steps involved in goals-based management. The first step is discovery, where we talk, that helps us to uncover your goals, understand your entire financial picture. The next step is for me to advise. That's why I work with you to assess various scenarios, advise on the appropriate strategies to meet specific goals, and then we implement and explore multiple accounts and products to identify the right combination to meet spending needs and invest in a tax efficient manner. And then from there, it's that ongoing communication, tracking progress, following your financial roadmap, so to speak, requires vigilance and flexibility at the same time. And I help monitor progress in real time, making adjustments according to your needs, life events, changing market conditions, and so on. It all starts with an understanding of what's most important to you, from the important people in your life and your goals, to your comfort level with risk, your vision of financial security and success. And I'm here to listen to your needs and help you find answers to important financial questions. That is it. And I thank you for joining today and allowing me to share with you how Morgan Stanley and I can help manage your wealth while achieving your financial goals. And I'll open it up for questions now.
Great. Thank you, Charles, so much for that overview. And if anybody has any questions, please go ahead and put them in the chat. And I actually have a couple here. So one of my first questions, Chuck, who manages your money?
That's a great question. Probably one of the most ask questions. I do, and I invest in the same assets that I recommend to clients. So there is skin in the game as things go up and down.
Sure. What's a reasonable estimated return on my portfolio over the long term?
Another good question. I think after accounting for inflation, taxes, and fees, anywhere between 3 to 4% annually is a good benchmark.
Okay, great. Again, if anybody has any questions, if you want to have me unmute you, I'm happy to do that for you, or you can type any questions you have in the chat box. So I'm keeping an eye on that as well. Another question I personally have is, how much would I need to retire or for retirement?
Yes, and that's one of the, with the financial plan, that it's a key in assessing how much you actually need for when you get there. There was a study, I think, a year or two ago about the centenarian population and how they're expected to grow like 8 times by 2050. So with that, we in the past we'd always use like 30 as the standard retirement longevity. Like if you retire at 65, we're taking, or say 60, we're taking plan out to 90. It was 30 years in terms of life expectancy. With this study, I think 40 is the new 30 now in terms of retirement longevity. People are living longer. And based on that study, by 2050, those reaching age 100 will grow 8 times. So there are a few rules of thumb to sort of ballpark what you'll need. One is based on salary. So it's essentially you take 10 times your annual salary, and that's what you'll need by retirement. The other way is to use your anticipated annual expense. And you can look at that in 2 ways. You can say, like, if you're forecasting 30 years of retirement longevity, the multiple is 25 times. So, if you're spending $100,000 a year after tax, $2.5 million is the amount you'd need for sufficient assets to last 30 years. If you want to account for the increase in longevity and make it for 40 years, so say from 60 to 100, that multiple jumps from 25 times to 30 times. So if it's $100,000 a year after tax, the needed amount by retirement is about $3 million. Those are some rules of thumb. And I think, again, with a financial plan, you can help assess how much you'll actually need at that point. And what I'm finding with retirees is it's a transition. It takes time to get used to not working, and I call it now like work optional mode. I don't even label it as retirement. And I'm finding more retirees are still doing something, staying active, keeping their minds active, and I think that's important. But revisiting that plan every year to have that peace of mind that you're on track, I think is critical.
I don't know about anybody else, but just hearing some of those numbers got my palms sweaty. So I think I am going to have to call you later, Chuck. But also, and knowing that folks are staying busy and have some supplemental income even after retirement. I know one of our podcast hosts, we do tell him that he's failing at retirement because he's taken on, I think, 3 or 4 new jobs now that he is retired, if you will, but he's failing at that retirement, I think, thus far, as we tease him.
Yeah, I think some are more busier in retirement than they were pre-retirement.
Absolutely.
They're doing more of the things they enjoy, I guess.
So one more. It looks like we have a couple questions coming in the chat. What are your fees?
It depends. So to do a preliminary financial plan that assesses all those key areas, there's no cost associated with any of that. The way that I'm compensated is if I actually handle investments. And that's up to the client whether or not they want me to manage their money. And it can be a fee base that ranges anywhere from like 0.3% to 1.25%, depending on the assets under management and depending on the conservativeness, aggressiveness of how we're allocated. So the way the industry is going too is it's tiered. So the more assets that we have under management, the lower the fee. The more conservative a client is, the lower the fee. So more assets closer to like the 0.3% per year, more conservative closer to the 0.3% per year. Lower assets is closer to the 1.25% per year, and if we're a little more aggressive, it can be closer to the 1.25% per year. And then that's it's prorated, so it's prorated on a quarterly basis. The client's never locked into anything. So if at any point they're unhappy, they don't like me, whatever the reason is, they vote with their feet, I lose client, and obviously I don't want that. So it's as close as we can get to being on the same side of the table as the client with the way that we're compensated.
Got it. Thank you. How important, another question we got in the chat there, how important is tax impact on financial planning? It's not something I currently have in my plan, and I'm unsure of how to approach it.
I'm sorry, I missed the question. How important is tax impact?
Tax impact on financial planning?
It's very important. It's when you're accounting for 15 to 40% of investment returns. Yeah, it makes a big difference in the long run. So whether it's trying to take advantage of lower marginal rates to prevent like a bigger income tax in the future, that's an important part of retirement planning, especially, or just looking for tax advantage ways to save for children's education or grandchildren's education through tax-deferred growth, tax-free growth. Those are all important things to assess to get the most bang for your buck in the long term with tax-efficient returns. Am I still on?
Oh, you are. I'm sorry. I was muted.
Oh, okay.
I apologize for that. I mute myself in between. And
That's all right.
I started talking and realized I was still on mute. I apologize. It happens every webinar, guys. For those of you who've been with us a few times, it usually happens to me at least once. Another question we had come in via the chat. Do you tax harvest at all or at year end?
Throughout the year and at year end. So around March end, when volatility was extreme, that was an opportune time to tax loss swap, harvest a lot of losses, get the tax benefit. And for those that are unfamiliar, tax loss swapping is when you sell something, you get at a loss, you get the capital loss. But instead of selling and bailing out altogether, you swap into other securities that are down just as much, but maybe in better financial health, with the potential for better long-term returns in the future, that we are not getting out of the market, but you're getting that tax benefit. So as things do improve and markets are going up and you take gains in the future, you're able to offset those with the realized losses that you took back in March. And then just standard practice is you assess that October, November before year end, just to make sure we're harvesting as many losses as we can to help offset realized gains.
Another question that just a follow-up, I think. Would you base retirement withdrawal on the 4% rule?
You can. So if you do the math with that example I gave of the 25 times anticipated annual expense for 30 years, that is about a 4% distribution. And then the rule of thumb for 40 years of longevity is about a 3% distribution, just over 3%. But the lower the distribution rate, the more conservative the projection.
Thank you. Any other questions from the group in the chat? Just let us know. I do have one more on my list here for you, Chuck. How much impact will the November election have on the market?
That is another question that's often asked. And I've never been a fan of politics, and believe for investment purpose, it's the fundamentals, the fundamental factors that matter and ultimately drive the market. We may see a pickup in volatility around the election or post-election. Politicians, unfortunately, love the spotlight, and some investors will watch the show, but it's not really a primary focus with my investment discipline. I like to focus more on those fundamental factors.
That's helpful. Thanks. I did have another question come in for the chat. Seen lots of ads for online services so you can manage your own investments and do it yourself. What are your thoughts and pros and cons on that kind of service and the DIY approach? Yeah,
if you can do it, have at it. I would say the one commonality on all clients for me is that they're successful. They're busy with and focused with what they do in their jobs, their careers. They don't have the time. They don't have the inclination to attend to all the financial needs. But I would say if you have the time and you're inclined, and you can sort of detach yourself emotionally and follow a disciplined plan, then more power to you. And it's become more cost efficient, more client beneficial to invest, whether with an advisor or on your own. Am I still on?
You are. I did it again. Usually I only do it once, but today
it would
is
help.
just my day.
Video would help. If I had video that I could see who's talking.
My bad.
Live and learn.
I was just saying, I will give everyone one last chance to send us any questions in the chat there. Thank you all for participating today and asking questions and being present with us. Really appreciate it. And thanks for finding your way over to GoToMeeting with us. So I haven't seen anything else come in. So I'm just going to say thank you, Chuck, for being with us today. And I'm going to go through a couple more updates. We do have Charles's contact information there on the screen. Also, if you scroll up in the chat to right as we were getting started, there is a link directly to his website, as well as one of the most recent newsletters that he put out. So you can click on the links there. And also a recording of today's presentation will be available on our website probably by tomorrow afternoon, and I'll include those links there as well. So thank you again, Chuck, and we really appreciate it.
Thank you for having me.
I will be in touch, and I hope others will as well. So thank you so much. A few more updates for you from Digital Enterprise Society. Please do check out our Digital Enterprise Society podcast. It's available on your favorite podcast streaming platforms, and new episodes are released every Wednesday. We also have as I mentioned, all of our webinars are recorded and are available on our website at digitalenterprisesociety.org/webinars. You can visit there and sign up for our next one, How Manufacturing Looks in Today's New Normal. This is going to be an interactive panel discussion, which should be incredibly interesting. We're going to have a moderator from Vertex Software, some people we've got folks from Boeing signed up, from a medical company, and some others. So it should be a great, very diverse panel, and we hope you will join us for that as well. Again, my name is Courtney McWhorter. I'm the Marketing Communications Manager at Digital Enterprise Society. If you have any questions about the organization, I encourage you to contact me. I'm happy to help. You can also find us on Facebook, LinkedIn, and Twitter. And once again, Digital Enterprise Society is a new nonprofit member association organized to enable the transformation of product development, design, delivery, and maintenance throughout the digital enterprise, regardless of software tools used. Visit digitalenterprisesociety.org to learn more. Thank you all so much for joining us, and have a wonderful day.